Hello everyone, my name is Yue. Today we're going to share with you the paper we chose, Stock-wise Technical Indicator Optimization with Stock Embedding. One of the essential approaches in quantitative investment is technical analysis. The approach is to forecast stock movement by address the inner rule from historical prices and volume. And the target is to address the vital noise nature of a financial market and form the foundation for robust and profitable investment strategies. So the challenge is really the stock with different properties have different affinities over technical indicators. That is a significant challenge for the indicator-oriented stock selections and investments. So in real quantitative investment, the technical analysis mainly used to select stocks targeting higher future return, and the technical trading indicator is actually the one used to deal with the noise nature of a financial market. The generic technical trading indicator is usually generated based on a uniform mathematical transformation over a historical prices and volumes of each stocks. So here are two of the examples of technical trading indicators. The moving average indicator that is smoothing the price sequence and discarding some of the randomness to describe the future trend. And the bias indicator that is computed as the deviation of the current price from its moving average robustly reflects the present condition of the stock price. So the technical indicator plays a crucial role in real investment tasks. However, the uniform transformation uses a limitation for the higher future profit selections. It can be like two stocks with almost exactly the same value for a certain indicators, but stay at inherently quite different states due to the different stocks' intrinsic property. So let's look at an example. Two charts for two different stocks. Both are time series data in terms of the price and bias in 30 days. Chart A on the left-hand side is more stable from time to time. The bias indicator in most cases will be limited in a way, and the chart on the right-hand side, chart B, with the gray volatility, you can see the volume is up and down. The bias indicator could be really easily jumping to extreme value. So the summary of the disadvantage of technical trading indicator is if it's for a steady stock like chart A, the bias indicator will provide rich information for both prediction and investment, but for the high volatility stock like chart B will not really bring you the equivalent valuable information. So the technical trading indicator optimization is introduced in the paper, which create a risk-scaling factor for each individual stock's properties based on the transformation over stock price and the volumes. So the challenge of it is really to get effective representation of stocks, which is based on the human experience. It can be unstable and costly, and the solution is to learn the stock representations, for example, stock embedding. So for like a common primary method to use to analyze stock, we usually have like two different analysis. The first one is a fundamental analysis, that is to use a financial statement, for example, income statements or balance sheet, to get a fair value of the business. And the second one is a technical analysis. We kind of introduced just now, and that is to study how past and present price actions in a given financial market to predict for the future. So the technical indicator to recognize trading patterns for specific asset based on a corresponding price and volume. So in this table below shows you a couple of popular technical indicators and the calculation formulas. So effective technical trading indicators implies the market future trend, and also traders rely on it to construct portfolio to hedge the risk and maximize the future return. And the evaluation metrics for indicator effectiveness. So the information coefficient is commonly used as a performance metrics for predictive skill of a financial analyst and the effectiveness of the trading indicator. So that is actually just to measure the skill of an investment analyst or a active portfolio manager in our real investment life. The information coefficient shows how closely the analyst financial forecasts match actual financial results, and the information coefficient can range from 1 to -1, which -1 indicate the analyst forecast bear no relation to the actual result, and 1 indicating that the analyst forecast perfectly matched the actual result. So both situations will be helpful for constructing the portfolio. So the highlighted in blue is the popular type of IC information coefficients calculation that is called the ranked IC. That is the correlation of the rank of value indicator at time t-1 and the rank of a profit return at time t. So the stock with different properties have different affinities over the same indicators. The stock-wise adjustment based on the stock properties is necessary to refine existing technical indicators.
Hello, I'm Yingzhao. Now I will introduce the research solution of this paper. First, stock embedding. In this section, stocks with similar probabilities have similar representations. The advantages of this paper, they seek to solve the problems by a data mining view, instead of just conducting labeling by the human experts. There are 3 steps of the stock embedding. Historical portfolios, bipartite graph construction, and the learning stock embedding within bipartite fund stock graph. For the first step, historical portfolios of the fund managers. As shown in this figure, the real-world data in terms of historical portfolios of fund manager is usually organized as 2 camp elements, funds and the stock. In this graph, left the funds and the right of stock. For example, the edge between fund FI and stock SJ, for example, WFI-SJ, represents the investment of the fund FI on the stock SJ. One fund can contain a list of different stocks, and one stock can be held by various different funds. This is to learn similar embedding for the stock held by the same fund. For the second step, bipartite graph construction. Bipartite graph G is equal to UVE, which can be divided into 2 disjoint and independent sets, U and V. It represents the fund's historical portfolio state into the bipartite graph by the mapping U to the set of the fund, V to the set of the stocks, E to the specific investment of the fund on the stock. The last step is learning stock embedding within bipartite fund stock graph. This is an approach to learn embedding for the stock nodes. These nodes appear near to each other. We be likely obtain similar embedding. They first generate the stock node random walk sequence based on the transition probabilities on random walk on the found stock graph. The first equation is equal to the probabilities of the going from stock node Sj to the found node Fi, like this one, given by the step k minus 1 is Si to the next step Vk to the Fj. And the second equation is the probabilities of go from the found node Fj to the stock node Si, like this one, when I have the step Vk is equal to Fj. To the next step, Vk plus 1 is equal to Si. Then they learn the stock embedding that maximize the probabilities of the neighbor node. Maximize the probability of the neighboring nodes condition on its representations given by Gu here, and NSU means the neighboring nodes for the node U. In this step, a neural network is also trained to predict the probabilities for each node to actually appear in the neighboring around the focus node. After that, embedding could be obtained through the hidden layers of the trained neural network. After stock embedding, they carry out technical training indictor optimization model. It also contains the 3 steps: learning model, rescaling networks for the indictor optimization, and rotation learning mechanism. First step, learning model. It represents the optimized, more effective indicators with a parameters model, instead of just generating a new indictor computing by just fix the equation in the traditional way. The second step, they propose a simple neural network to calculate the raw rescaling score for a specific stock I with respect to an indictor J, as shown in the equation, this one, Rij equal to the Fj transpose multiplied Gi. And they normalize the raw rescaling weight over all the stock via the softmax operators as shown in the equation 2. In order to correctly change the order of any indictor, they normalize the raw indictor value into the range to 0 from 0 to 1 by multiplying the normalized indictor Iij with the rescaling weight alpha ij here. We can obtain the final optimization indictor. After these 2 steps, there is a loop adapted to the dynamic natural investment, like this one. Data becomes available in sequential orders and is used to update the predictors for the future data at each step. This is all the research solution for this paper. If you have any questions, please ask us without any hesitation.